Daily chart, we have yet to get above. We have another bull close, but body's getting smaller. Makes me think tomorrow has a reasonable chance of gapping down or selling off during the overnight hours. There we go. I just wanted to adjust the microphone. So the daily chart, you can see right here, we have a basically spike and channel. Put me on my other computer while I'm thinking about it. There we go. So we had a spike and channel, and we have this buy climax late in the rally. And if we look at a weekly chart, one, I think we're going to test down here at some point. If we look at a weekly chart, we can see this is the weekly chart. And obviously the spike and channel just becomes a tighter channel on the weekly chart. But the one thing that's worth thinking about is the consecutive buy climaxes breaking out above this high, this buy climax here late in the rally. Look at the open of this bar. The open of the bar is 40.5. This was last week. And look at the low of the bar, 37 even. Well, look at the open of this bar. The open is 45.5, 45 even. And look at the low of this bar, it's 41. So the tail is actually getting smaller on this week's open compared to last week's open. And that's a sign of a buy. That's climactic trading. That's a sign of higher momentum trading. And whenever that happens late in a rally, it actually increases the chances of the market getting a pullback. So I think ultimately we're going to test back down to this area, 6,400, 64.5, 6,450, somewhere in there over the next several weeks. But it could take more than just 2 or 3 weeks to get there. It could take easily 5 or 6 weeks. 5-minute chart, we gapped up on the open, and I made the comment that I thought that because of all the price action, we had on the daily chart when the market gapped up and yesterday had this big rally and then sharp sell-off late in the day, I thought the odds were reasonable that there'd probably be sellers above the high. And because of that, I thought that today was probably going to have a lot of trading range price action and ultimately try and test the high of yesterday. By the way, whenever I say yesterday, I mean the high, the prior trading day. So if it's Monday and I say yesterday, I mean last Friday. I don't mean Sunday or Saturday. On the open, let me do it like this. On the open, bar 1, we have a bull bar, but a pretty big tail above the bar. And that makes me think that there's probably buyers below 1 and we'll probably get a second leg up. But I ultimately think we're going to test the magenta line, which is last Friday's high at bar 65. 2 consecutive bull bars, 1 and 2. Good for the bulls. We'll probably get at least a small second leg up. However, overlap on 1, overlap on 2 increases the risk of a pullback. And then 3, outside down. Good for the bears. We may get a small second leg down, but it's basically an expanding triangle. We have a high on 1, we have a high on 3, we have a low on 1, we have a low on 3. And just like the rally on bars 1 and 2 failed, the sell-off on 3 could easily reverse. So it's really not as high probability as it seems. Bull bar on 4, good for the bulls. Bears, they'll see it as 2 legs up. But we're getting a lot of overlapping bars. And the bears that sold the close at 3, they're obviously disappointed by the rally up on 4. 4 gapped up on the open of the bar compared to the close of bar 3. And what do you notice about the low of 4 and the open of 4? The market rallied from the 4 low to the high of the day, to the high of bar 4. That means that traders who tried to sell the close of bar 4, traders that tried to sell the close, to buy the close of 4, buy the close of 3, the market went straight up, and therefore a lot of buying on the open of 4. 5, consecutive bull bars, good for the bulls, probably going to go a little bit higher, but tail 4, tail on 5. Look at bar 5. 5 looks like a strong bull bar closing on its high, but the majority of the bar, maybe 90% of the bar is overlapped by bar 3 or by bar 4, and that increases the chances that we pull back soon. But consecutive bull bars, probably always in long in a second leg. 1 second here. I'll have to answer the door in just a second. But what I was saying is consecutive bull bars, there's probably buyers below the close of 6, and therefore we'll probably get a bounce. But 3 consecutive bull bars, I suspect the first reversal down is going to be minor, and we'll probably get the second leg. Okay, give me just one. I just need about 1 minute here, and I'll be back. Okay, I'm back. Thanks again. So anyways, what I was saying is 3 consecutive bull bars, probably buyers below in a second leg. Outside down on 7, that's disappointing for the bulls, but it's not unexpected. We had a lot of overlap, 4, 5, and 6, and that increased the odds that whatever reversal down we got was going to find buyers and bounce and get the reversal. 7 and 8 consecutive bear bars, probably buyers below in a second leg up for the bulls. You can see for the bulls, the channel up was tight. In a couple ways, there's a couple things to think about here. Whenever you get a reversal down on 7, usually 7, wait a minute, 1 second here. Whenever you get a reversal down, such as bar 7, it's a strong enough bar that it's likely to get a second leg up. And what that means is the traders who sell the close of 7 and put a stop above 7, the market's probably going to go down for at least a bar or 2 before it fails. The odds are 7 is going to fail, but it's probably not going to fail immediately. And therefore, when bar 8 forms a weaker bear bar, it's got a tail above and a tail below. What does that tell traders? It tells traders that bar 7 is probably going to fail. And because the bodies are getting smaller, the momentum down is getting smaller, and traders are going to look to buy. They still, because of consecutive bear bars, they still may wait for a smaller bar. At 9, we have a bull bar, a reversal up. That's good for the bulls, but it's still following consecutive bear bars, and that increases the risk of sellers above 9 in a second leg down. Bar 10, we have a breakout pullback sell for the bears, but a tail below 10. And what do you do if you're a bear and you sold the close of 8? 8 consecutive bear bars, reasonable to sell the close. It's not a good sell the close, but it's not a terrible sell the close, but it's not, well, let me say it differently. It's okay to sell the close if you can manage the trade accordingly. When traders see 9, what do you think they're going to do on 10? A lot of those traders are going to buy back their shorts on the close of 10. And that'll increase the odds that we get a bounce. 11, outside up, good for the bulls. It's a second leg up after 9. But 11, tail above the bar, near resistance. I suspect that the first reversal up might be minor, which means there might be more traders selling up here rather than buying. And instead, 12, we got the bull breakout. For the bulls, strong enough bar, probably going to get at least a second leg up. Reason I said there might be more sellers above 11 is because the market may have to pull back and test the low one and then find buyers. But in this case, it's basically a high one. Breakout, pullback, buy setup. It's a high one buy. The market tried to go down and then it reversed up. 12, bull bar closing on a tie. Good for the bulls. Probably going to go at least a little bit higher. And then what do you see with 13? 13 is a bear doji, and that's a warning to traders that the market's probably not going to go a lot higher. 14, bear bar, tail below the bar, increases the odds that there will probably be buyers below, and therefore we're probably going to get a bounce and a second leg up. 15, bull bar closing near its high, but failed to close above the 13 high. Probably going to go at least, I suspect it'll probably go sideways here. And then 16, bear bar closing in the bottom third of the bar. Probably buyers below the bar. But we have a wedge with 7, 13, and 16. And that increases the odds that the market is going to go more sideways here. 18, bull bar, breakout, pullback, buy. But that's a high one buy really late in a bull channel. And therefore, there's probably more sellers above the high of 17 rather than buyers. It's kind of like this over here. We had a gap up late in a channel. So here's the channel. We have this spike in channel. We have a gap up, so a breakout. And we have this weak high one buy late in the channel. That increases the odds that there's sellers above and we'll get a pullback. So here, sellers above. We're probably going to find sellers above in a second leg down in a test of the 15 low and possibly all the way back down to the 3 low. Because of what I mentioned about the daily chart, I thought the odds were reasonable that the market would test down back to the open of the day. And then 18, follow through for the bulls, but a lot of overlap increases the risk of sellers above. And then 19, outside down, probably going to go sideways here. And therefore, that makes me think that the market is probably going to get a second leg down. We're losing too much momentum for the bulls. 20, good bar for the bears. What about selling the close? The only problem with selling the close is, and what do you notice about the rally from the 9 low to the 18 high? We have yet to get a close below the low of the prior bar. And even though it's a micro channel from the 11 low to the 16 high. And that's a sign of trending behavior. And that increases the risk that 20, the trend line break, the bear bar closing on its low, it increases the risk that there might be more traders buying it. Now, the problem with buying the close of a bar like 20 is that if you're buying the close of a bar such as 20, you have to think about what is the expectation behind the trade. There's probably sellers in the upper third of the bar. So if you buy the close of 20, at best, the market's probably going to bounce, find sellers in the sell zone, the upper third of the bar, and then test back down. And that's what happened with 21. Other traders, rather than selling or rather than doing anything on the close of 20, a lot of traders will wait and see what the follow through looks like. And when you look at 21, does it look like a good bar to buy? Of course not. It looks like a terrible bar to buy. And so what are traders going to do when they see the close of 21? They're probably going to be interested in selling the close. If I was a bear, if I was a bull and I was long on 21, if I was a bull and then I saw 21 be the bar that, let me say it differently. If I was looking to buy on a stop entry, I'm not going to buy above 21. And if I'm not going to buy above 21, then what does that tell me if I'm a bull and I'm long on the close of 21? It tells me I need to exit the trade, because if 21 is a bad buy above the bar, that means 21 is a good sell above the bar. 22, inside bar for the bears. Good for the bears. But we're still inside of a tight trading range with most of the bars above the moving average. The bears, what they really need, they need a couple of things. They have a couple of options. They ultimately need a successful breakout below the moving average. They can get one large bar closing below the moving average, not the most ideal. They can get a series of bars closing below the moving average with a little overlap. That would be the best case scenario. Or the market can drift down to the moving average, stabilize at the moving average, and then start closing below the moving average. And that's basically what happened today. 22, bear breakout, good for the bears, a little bit of a surprise. But what do you notice about 22? As good of 22, good as a bar 22 appears to be, it's a second leg down from the sell-off to 21, and the channel up to 19 is fairly tight, and there might be more traders buying here rather than selling. 24, I meant 22. I said 22. I meant 23. 24, inside bar, but forcing bears to sell at the moving average, not ideal. Probably buyers below. But I suspect the bears selling here and scaling in will make money. I'd rather wait and see what the reversal up looks like. 23, bull bar, and it's an implied wedge. First push 21, second push 23, third push 25. But a weak bull bar, probably sellers somewhere above. 26, bull bar closing on its high, but really not ideal. We have a weak buy signal bar for the bulls who bought above 23, and that means there will be some bulls scalping out, betting that the market will test back to the 23 high. We have bears who sold the 23 high, betting that it was a weak buy signal bar. And what are they going to do? They're going to scale in higher. They sell. I said 23, I meant 25. At 25 is a weak buy signal bar for the bulls. And therefore, some bulls are trapped out of the trade. Other bulls will scalp out because they know that bears are selling the high of 25, expecting it to get retested. And you can see it got retested on 27. A lot of bulls, if they bought above the high of 26, they're not going to... A lot of bulls, when they see 26, they want the follow through to happen pretty quick because they know 26 is a decent bull bar in a sell zone. The sell zone being the middle of this sell off to the upper third. And so it's getting near a sell zone. If 26 fails to rally quickly at the close, that means traders will look to sell during 27. I mentioned that earlier in the day. I made the comment that I sold below 27. I thought about selling above 26. However, I was not willing to sell the high of the bar. I wanted to see what 27 would do after 26 closed. And when the market rallied during 26 somewhere up here and started to pull back, it happened too quickly, and therefore I was trapped out of the trade. And because of that, it made me miss the trade, and then I sold below 27. But the point is, bulls, if they bought 26, if the market doesn't do what they want quickly, they'll be fairly quick to exit. 27, bear bar. Not a great sell because of the risk reward, but it's reasonable, especially if you're willing to use a wide stop scale in. And then 28, bull bar, reversal bar for the bulls, second entry buy, but really not ideal. It's still forcing you to buy in what's likely to be a triangle following a decent sized bear bar, 27. And then you can see what happened with 29. 29 tested near the 27 low, trying to relieve the trapped bears, but they couldn't quite get out. Because of the overlap, 29 after 28 makes me think we're still going to go sideways. 30, doji, not a great sell below, so probably buyers below in at least second leg. But I suspect there's probably sellers above 28 and the high of the day because of the higher time frame context. We're probably going to test somewhere down here, and I suspect we'll try and close this gap. Bear bar 31, but inside of a tight trading range and a triangle. The triangle being bars 23 to 31, right above the moving average, so not ideal. It's a bear bar closing on its low at the moving average instead of below it. Bull reversal bar on 32, good for the bulls, but I suspect there's probably sellers. Triangle, if we do break above, it'll probably be a final flag. And then 33, really not what you want to see if you're a bull hoping for the breakout above the triangle. That's a sign of weakness. And then the market reversed down on 34. Let me see if it went above the high of 27 right here. 8 at 75 and 9 even. So price went one tick above the high of 27, reversed down as to be expected. Not a great sell below 34, but if you can use a wide stop, scale in, probably okay. I think it's really difficult for the bulls buying right here. There's just the risk for the bulls. I think the risk is big for the bulls because I think the odds are good. We're going to fall below 23 and probably test down here. And for the bears, the math is actually fairly interesting. If you're a bear selling really anywhere in here, even the odds are any breakout above 19 is probably going to fail. So you're willing to sell and scale in, and you're willing to take a chance we get a reversal down and a test into this zone, you're probably going to make at least 1 times whatever your risk is on the trade. And that makes me think that the odds are stronger for the bears. Bull bar, 35, but a tail above the bar, not ideal. But the channel's tight, and then 36 second leg down after 34. But a tail below the bar at the moving average. What do you notice about the moving average? We touched the moving average 23, and then we bounced 24. We touched the moving average 25, and we bounced for 2 bars, 26, 27. And then during that same bar of 27, the market reversed down back to the moving average, and we went sideways to up. That's a sign of disappointment for the bulls. 38, bull bar, tail above the bar. We're getting more overlap. The channel is tight for the bulls, but it looks like it's just barely holding above the moving average. Every time we touch the moving average, we break above it. We break away from it, but it's only for a bar or two, and then we touch the moving average again. That's really not ideal if you're a bull. And then 39 inside bar, looks like we're going to test below the moving average soon. 38, and then 39 bear bar at the moving average, probably going to go a little bit lower, not a great stop entry buy. And then follow through, but a tail above the bar, a tail closing above its midpoint. Not a great buy above, so probably going to go sideways to down. And then 41, we have an inside bar. That's good. It's a bear bar, so it's good for the bears, but it's still a sign of weakness. But bears are starting to own the market in terms of time. We're getting a micro channel, high of 37, low of 40, and 4 consecutive bear bars increases the odds we go a little bit lower. 42, strong bear bar closing on its low. But what's the risk for the bears? What's the risk for the bears? Well, right here. I made the comment on the 15-minute chart. One of the concerns was this channel during the Globex session was tight. We had consecutive bear bars, pullback, and then a surprise right here. And so where we are in the review is this bar right here. This bar closed. And I made the comment that one of the problems for the bears could be if this bar is a bull bar closing on its high. And then the bulls tried, but they couldn't quite do it on 43. And 43, it's a disappointment bar for the bulls, increases the odds of sellers above. Now there's trapped bulls, and therefore, there's bulls who bought the 23 low, they bought the 40 low, they bought the 41 low. They basically bought anywhere in here, and they're disappointed with 42. 42 is just 1 bar. So what do you think they're thinking? They're thinking, dang, 42 is disappointing, but let's see the follow through 43. And 43, rather than being another strong bear bar closing on its low, instead, 43 was a disappointment bar, and it's a doji, and that increased the odds that the market will bounce, which it did on the very next bar. But the bulls who bought the 41 low and more lower, what did they do during 44? A lot of those bulls sold out of their longs, and that's what led to the tail below the bar. Probably going to get a second leg down because of the sell-off from the 37 high to the 42 low. And we have magnets below, the 3 low and the 65 low. But one of the problems so far with the sell-off is, look at this sell-off. It's really only 1 bar closing on its low. And whenever you have a day where most of the bars are fairly overlapping, that increases the risk that we're in a trading range. So we have 1 decent bear bar, but then overlap, and that's a sign of disappointment. Give me just 1 second here. And 45, we have the second leg down for the bears. Good for the bears. Probably going to go a little bit lower. I suspect we'll probably get down to the 3 low, but it makes it difficult to sell. By the time you think the market's bearish 42, it gets a deep pullback, and then you see 45. What do? Do you sell the close of 45? Well, 46 might be a bull bar closing on its high, and if it is, that may trap traders. And instead, look what happened with 46. 46 instead formed a bear bar closing on its low. Consecutive bear bars, 45, 46, good for the bears. Probably going to go a little bit lower. Possible wedge, 36, 43, 40, 46, so we may get a bounce. And then you can see what happened. The market sold off on 47 and then reversed up on the close, reversed up to on the close of 47, but a tail above the bar after a 3-bar bear micro channel, really 4 bars. Some bears who sold the close of 46 disappointed with 46. What will they do? They'll be pretty quick to get out, break even, back to the close of 46. And you can see the market let them on 48. 48 low one short, not ideal, probably buyers below. And then a bull bar, 49. Good for the bulls, but magnets above. We could test the high of 43, the top of the channel. We had a spike, or really a spike 42, pull back to the 44 high. And therefore, this is the top of the channel, so we could probably test up there. We have this breakout point over here, 23, 25. We could test up there as well. Decent bull bar, 49, follow through 50. But there's a subtle warning that something is wrong with 49 and 50. Do you see what it is? The problem with 49 and 50 is the tail on 49. That's a lot of overlap. So this is a rally pullback, and then consecutive bull bars with overlap. That's a sign that not as many traders are trapped. It's still consecutive bull bars, and therefore will probably go at least a little bit higher. But one of my concerns is this channel down is tight. So if we get a rally and we start to go sideways and stall, that might be enough for traders to start selling again. For me, if I'm a bull, if I'm a bear, there's no way I'm staying long. There's no way I'm staying short here. 51, 3 consecutive bull bars, probably going to go higher. 5-bar bull micro channel. Follow through 52. That's good, but overlap with 51, not ideal. But we're getting trending behavior. Every low is at or above the low of the prior bar. And so far, ever since bar 49, prices at least, let's see, so the close of this bar, 4.5, high of this bar, 4.5. Ever since 49, we've had a close at or above the high of the prior bar. And that's a sign of decent buying pressure. But context is a problem, middle of a trading range. And then we have a doji all of a sudden. So bulls are hopeful, 51, 52, that the market's going to go higher. And then it starts to go sideways, disappointing. Markets typically break out and then contract. And therefore, this is a pullback. What do you expect after the pullback, 53? You expect buyers who are probably going to at least get a small second leg up. And then 54, you can see what happened. The market rallied. But it makes it difficult. You're in the middle of an overall tight trading range right here. And we're right around the magnet. And this could be an area of profit taking by the bulls. We have a buy the close rally and then a doji. That increases the odds that there's probably going to be sellers above the doji, and the market will probably find profit taking within the next bar or two. 55, bear bar, decent tail below the bar. So the market broke out, pulled back. And that's a sign of decent selling for the bears. And that's a sign of selling pressure for the bears. Weak high one buy. So probably sellers above and sideways. And then a bear breakout on 56. 56, bear bar closing near its low. That's good for the bears. It's a little bit of a surprise. And therefore, that increases the risk that the market will get a small second leg down. What about buying? What about selling or buying the close of the bar? Well, it's one of those kind of situational bars where it's a breakout. We have a bear breakout, and traders want to see what the follow through is going to look like. Will it be a strong bear bar, or will it be a disappointment bar? And traders that means that traders will probably look to see what the follow through looks like. Doji 57, so fairly neutral bar. That increases the risk that there's buyers below. But we have a 1, 2, 3, 4 bar bear micro channel. In the past 3 bars has had a low at or below the low of the prior bar. And that's a sign of disappointment. 57, not a good buy for the bulls. Increases the risk of sellers above. I made the comment that this trading range, one of the challenges with this trading range is that the market sold off on 47, touching the 3 low. And we have overall higher time frame magnets. We have a gap on the daily chart, the 65 high from Friday and the low of bar 3. And this is a reasonable magnet. So I thought that it's possible that this forms a lower high. A good rule of thumb, whenever you're in a trading range, you never know when the market's forming a rally, you never know how many traders are just waiting to sell at a lower high. And you never know how many dollars are just on the sidelines. So even though it looks like the bulls are in control and they're buying, you don't know if that's bulls buying aggressively or if it's just bears stepping aside and waiting. And whenever you see a lot of overlap, it's good to assume that a lot of traders are just stepping aside. The same thing can be said for the sell-off down to 47. So you see the rally, it's going sideways, it's pulling back. Now we have a bear breakout, 56, and then consecutive bear bars, 57, 58, going sideways, increases the odds we'll get a bounce. 59, bull bar, but a weak high one buy, and a micro channel. That's not a great buy signal bar for the bulls, so probably sellers above. And look what happened, 60 outside down. Why is 60 important? Well, 60 for 1, it corresponds to a round number. But 2, the channel down is tight. And therefore, on the 15-minute chart, this might be consecutive bear bars. And if we go over to here, we had a decent bull breakout, follow through, and then we had these 2 bear bars here. So here and here, bear breakout, follow through. And I thought because of that, this was strong enough to at least get a second leg down and possibly fall 1 tick below the low of this bar right here. And that made me think that even though it's an implied 2 legs down, 60 is a reasonable bear bar closing on its low. It's probably okay to sell below the bar, betting that we'll fall below 47 and test this breakout, this gap from last Friday. Bull bar 61, pull back after 60, but probably sellers above the 61 high, and we'll probably get a second leg down. 62, bear bar, good for the bears, probably going to go at least a little bit lower. And then 63, strong bear breakout. But 63 is actually a disappointment bar for the bears. Why would 63 be a disappointment bar for the bears? 63 is a fairly large climactic bar. And that is a sign that 63 is more of a sell vacuum test of support than traders selling aggressively. Plus, 63 has a tail below the bar, and that increases the odds that there's more buyers in here than sellers. We have a spike in channel, 2 legs down. We had a decent rally up here. I made the comment that bulls buying 54, buying more down here. What are they going to do down here? But this is kind of the tricky situation. It's probably okay to buy back your shorts. It's probably okay to sell out of longs below 47. But if it's a trading range, you might be selling at the bottom of the range. And therefore, it's really not the best thing to do. And when you see 63 with a tail below the bar, what does that tell you? It tells you the market's probably not going to have a successful breakout. So a lot of traders, regardless of whether or not they bought up here and scaled in, what are they going to do when they see 63? You know that a lot of those traders are going to buy. And that's what they did on 64. 64, bull bar, closing near its high. Good for the bulls. Probably going to go at least a little bit higher. 65, consecutive bull bar, 64, 65. Good for the bulls. I suspect we're going to get a second leg up. 66, a bear bar, probably buyers below in a bounce. Because of the consecutive bull bars, I suspect at least a small second leg up is likely. However, type bear channel, type bull channel, then type bear channel. Now we have bull bars. Even though the odds are we're going to get a second leg, this is inside of a trading range. And that is a strike against the bulls. that makes me think that the pullback is going to be more disappointing than what seems reasonable. Look at every breakout today, and you'll notice that every breakout had a fairly disappointing pullback that was a little bit more prolonged than what traders wanted. And then bulls bought the close of 65, disappointed 66, and then outside down 67, getting out break even. Bear bar closing on its low 67, but testing the breakout point 64. And I still think there's probably more traders buying below 67, but it's not an easy trade. We have a high and then a low, then a lower high, lower low, lower high, lower low, lower high. Bears want a bear channel. But the problem for the bears is decent buying pressure. That increases the risk that we may form a higher low right here and find buyers. 67 bull bar, and then 67 bear bar, and then 68 a bull bar. But if you go back and think about the formation of bar 68, what you'll realize is 67 did not trigger the sell and 68 immediately go up closing on its high. What actually happened was 67 got triggered during 68 and the market started to stall and go sideways. And then in the final, maybe minute of the bar, the market started to reverse up, or even maybe the final 30 seconds. And so it trapped the bulls. Okay, bull bar 68, but it's similar to, where was it over here? It's similar to this over here. Decent bear bar 27, decent bull bar 28. Whenever you get a decent bear bar 67, decent bull bar 68, it usually makes the market go sideways. $69 doji, second leg up after the tight trading range. Good for the bears, but I suspect there's probably going to be buyers below 68. Below 69, and we'll probably get a second leg up. I still think 64 and 65 are strong enough for that second leg. However, this might be one of those delayed second legs where the market rallies, goes sideways, and then gets a delayed second leg. That's fairly common inside of a trading range. We have a bear breakout 23, delayed deep pullback, and then a delayed second leg down. Bear breakout, deep pullback, delayed second leg. Bear breakout 56, minimum follow through 57, sideways 4, 5, 6 bars, delayed second leg down. That's a really common thing in a trading range. Here, bear breakout, deep pullback, delayed second leg down. Bear breakout, deep pullback, delayed second leg down. Big bull bar here, sideways for 4 bars, delayed second leg up. That's my general expectation of a trading range. 69 probably buyers below, and 70 bull bar. But bull bar in the middle of a tight trading range. Look at every bull bar on this chart. The ones that seem reasonable usually go sideways. We have a rally up to here, deep pullback, bull bar closing on its high 9. What happened? The market went sideways for a bar and then rallied. Bull bar here, follow through, and then a pullback. What happened? Sideways. Bull bar right here. What do we think is going to happen? Probably sideways. And then we got a bear bar on 71. Not a great sell for the bears, probably buyers below, but we're getting near that bar 72 window. And typically bar 72, which corresponds to 3:30 Eastern time, 2:30 Central time. If the market's going sideways around bar 72, usually it's better just to let the day be. And then 73, not a great buy for the bulls. What do you notice? If a bull bought above 70, their entry price is 71, 75. They're disappointed here, and then look at the high of this bar, 72 even. What that means is 72 went one tick above their entry price for the bulls who bought above 70, allowing them to break even on the trade. They buy, disappointed, get out, break even. 73, not a great buy for the bulls. And then 74, outside down. What about selling below 74? It seems reasonable, but time is against you, and you're still selling in the middle of a tight trading range, so it's really not ideal. You'll have some traders sell it, and if the market goes sideways or doesn't race down quickly, they'll exit. And in this case, it never triggered. And instead, what happened? Bears who sold the close of 74 got trapped 75, gave up 76. Decent bull bar 76. But it's only one bar closing out of this trading range. A little bit dangerous to buy the close here. You might have traders selling it. And you can see the bears who sold the close, the market quickly sold off, and traders ended up taking partial profits. Why would they take profits? Because for one, the rally is from here. On some time frame, the rally is from here to here. And therefore, when the market sold off like it did here, you'll have disappointed bears buying back shorts and bulls looking to buy. It's also a test of the bottom of this channel right here. And then 77, we got the bull bar testing the 19 high. And then you see we just went sideways here. What I think is interesting right here is let me just look at a 60-minute chart, just because we're going into the Globex session. We had a rally and then a trading range here, decent bull bar, deep pullback, second leg up, bear bar. What about selling below this bar? You might, but it's still tough. I think this rally up to here is strong enough that we may have to go sideways for several bars. But assuming this current hour closes near its low or at least below its midpoint, it's possible that it does lead to the highs. You have a bear bar here, assuming it closes where it is. Then you have a bear bar here. This could be a double top that goes sideways, breaks below the neckline, falls for a measured move. But not all that clear. We still have a lot of bars above the moving average. For stop entries, the first reasonable buy, maybe above 5. I don't think it's that great. And then when you see 6 be weak follow through, a lot of traders will exit during 7. Otherwise, you just hold long, and then probably okay to buy above 9 or to wait for a second leg. But if you wait for the second leg, it's tough, because bar 11 is a big outside bar. Bulls, they're long. They don't have to get out here. I think they definitely get out somewhere in here, either below this low, 16, or below 7, below 19, below 20. All that's okay, below 22. And then to parabolic wedge, 1, 2, 3. I think it's okay for traders to exit above this bar. Tight bull channel, really not ideal. Really not ideal. And therefore, I think all of these stop entries are really, really tough. And then I thought for the bears, probably okay to sell if you're really quick. Maybe you sell below 43 if you understand the logic that we may test down here. You can sell below 42, or you can wait for the reversal to try and reverse 43, 44, sell below 45, sell below 46. But all that's really tough. It looks easy real time, but it looks easy at the end of the day when the chart's printed. But it's much more difficult in real time. Bears, if they sell below 46, I think they have to get out above 49. Most of them would get out much sooner than that. 48, weak short below, so probably buyers below. Bulls, they can buy 49, they can buy above 50. But when you see the sideways trading during 52, 53, 54, I think you got to get out. Too much risk of a lower high. And then bulls, they get out below 56 for sure. Bears, they can sell, and not a good buy above 59, not a good buy 61. Second leg down 63, but then a wedge 23, 47, 63. 2 legs down with a lot of buying pressure through here, a lot of buying pressure up here. I think a lot of traders would be smart. The bears would definitely be smart to get out above 64. Bulls, they can buy above 64, stop below 63. Then what do they do with 67? It's not easy. But the reality is 67 is an outside bar following a decent breakout, 64, 65. Probably buyers below 67 in a second leg up. And then bulls, they can be long above bar 68. And they don't sell below 69, so no reason to get out. The bears, they don't sell 71, 72, no reason to get out. I think it's okay to get out below 74. And then realistically, this looks tradable, but most traders shouldn't do it. It's just really easy to lose money. So for me, I think 70 is kind of that last attempt to get the swing trade into the day. And then for me, I was long during 70, and I don't know where I got out. I think I got out during 72 or 73. I got out somewhere break even in here. And my general rule is at 72, if the market's not breaking out by bar 72, it needs to set up the swing trade. And if it doesn't, and it's going sideways, usually it's better just to wait. Limit orders, I thought buyers below 4, probably okay. I thought buyers below 10 made sense. I thought sellers above 18 if you're willing, or above the 16 high. Buyers below 24. I thought sellers above 27 made sense. Therefore, sellers above 36 made sense for a second leg down. I thought sellers above 43 made sense. I thought buyers below 48 made sense, but it never triggered. I thought buyers on a pullback, but once you got a series of bull bars up here, I thought this was pretty late. We have a spike pullback channel, and then we have a late buy climax in the channel 54. If you think about it, a micro channel, we know that a micro channel is a series of bars. In a bull micro channel is a series of bars that are at or above the low of the prior bar, where the low of the bar is at or above the low of the prior bar. That's a micro channel. And if you think about the word, micro means small and channel means a channel. So what this really means here, micro channel means small channel. And therefore this is a spike pullback channel on a smaller time frame and a failed breakout above the channel line during 54. And that's why it reversed down on 55. I thought sellers above 59. And then I thought buyers realistically below 47. And I thought buyers during 64, I thought buyers in the bottom third of the tail on 63, buyers below 66, and that's probably it for limit orders. Buy the close, sell the close. I thought most of today was really buy the pullback instead of buy the close, sell the close. So 3 consecutive bull bars, it's probably buy the pullback instead of buy the close. Consecutive bull bars, probably buy the pullback instead of buy the close. And then same with bar 42. 42, probably more of a sell the pullback than sell the close. And then 46, sell the close, but you got to be really quick to get out of the trade because consecutive sell climax is at the bottom of a trading range. Maybe buy the close 50, not ideal. And then sell the close 57, maybe, not really. Good enough for a second leg down, but I think pretty tough overall. Okay, let me take a look at questions. One second here. A question, do you still track the data of all your trades at the end of the day? What strategies? Okay, so 2 questions. Do you still track your data of all your trades at the end of the day? I do. I'm not always the best about it. I don't always do it every day, but I get to it at some point. So maybe, I'm always thinking about the performance, what's working, what's not working, tweaking things. But I'll still log the data. So I might be a week behind. Maybe a lot of times what I'll do is I will over the weekend or on Friday, I'll start to catalog all the data and think about the prior week. Right now I'm thinking about the prior week's data and making adjustments to it. That's generally kind of what I do. But, for me, what I really think the most about is I'm always thinking about the trades that just had bad math or that just didn't make sense. And that's always my primary focus. Is there anything I did, like right now, I'm thinking about the day and I'm thinking, one of the things I often do is at a minimum, I think about the trades I took and was there any trade that just didn't have good math, that was poor management that I need to think about and think through a process of, are my processes working? And it's different for everybody. I think though, at a minimum, the best thing you can do is really record all your trades and then log it into something. If you're lazy like me, I just say kind of jokingly, log it into TradeZilla or some other program where you can log the data and think about it. Logging data is important and that's great, but the reality is you have to do something with the data. Data on an Excel spreadsheet is meaningless if you don't do anything with it. Okay, then what's your second question? What strategies suit prop firm trading in your opinion? I am probably not the right person to ask about prop firm trading. I'm not really a fan of prop firm trading. And I think you have to be careful about it because realistically, I think one of the problems there's a fundamental issue with prop firm trading. And I'm assuming you're talking about these online prop firm accounts where you pay money and then if you do well, they'll give you an account and they'll pay you for it. There's a difference between going to a firm like I forget the names, but Schoenfeld. There's prop firms in New York and Chicago where you trade their money. You apply to them, and if you're a good trader, they'll hire you and you'll make a deal with them. But that's a whole different ballgame. That is one where it's basically those prop firms, you have a seat at the table and there's 100 applicants waiting to take your spot. And so you have a lot of pressure to do the right thing. One of my fundamental issues with prop firms that are online is it can be very tempting to, if you think about it, traders are paying, $100, $200 for the chance to get a live funded account. And what does that teach? And so the fundamental challenge with it is what you're doing is you're paying a monthly fee for an account. And by paying for them, and then so you're naturally incentivized to meet the standards, you don't have to pay the monthly fee anymore. And so what does that do to your psychology? It forces you to want to be aggressive. And then if you think about prop firms and you think about a payout, you're trying to hit a goal, you're trying to hit a target so that you can make money on the prop firm. I think that's also really, really dangerous because what does it do? It begins to remove objectivity and causes a trader to think more emotional. And that's a really dangerous thing as a trader. And so for me, most people aren't going to like my answer when it comes to trading. I think the best thing you can do, even if you have $2,000 or $1,000, really study, trade one micro and just get really good at one micro. And then once you can do that a little bit, maybe trade one micro and scale in one micro. The reality is, I used to have a spreadsheet and I wish I could show it right now. And I don't feel like doing the math, but the point is, if somebody could make $50, let's just do the math, keep it simple. If someone can make $50 every day, and they trade 185 days out of the year, they'll have $9,000. And you're thinking to yourself, well, that's ridiculous. That's $50 a day. I can't make a living off that. Well, as Al always says, when you're starting out trading, you're not going to get rich. But if you can make $50 every day and do it reasonably well, at the end of the year, you'd have $10,000. And then if you could focus on just trading, reasonably things, eventually that 10,000 turns into 20, and that 20 turns into 40, and that 40 turns into 80. I think that what traders really should focus on when it comes to trading, get really good at one contract. And if you're confident in your ability, you can scale in once or twice. Once you do that well for a while, trade two contracts, scale in once or twice. So you trade one contract, you scale in once with one contract or twice with one contract. You trade two contracts, you scale in once with two, and then a second time with two. And then you do three, and then you do four, and then you do five. And before you know it, you'll start trading reasonably well. But I think one of the challenges with prop firms and all these other kind of things is it's kind of like holding gold in front of you and saying, hey, if you go this route, I'll give it to you. And all of a sudden you start thinking emotional. And I think a lot of people get their psychology really damaged. I've been involved in trading since, maybe 2012, probably July of 2012, if I had to guess. And, so let's just call it 13 years. I've watched the Emini for about 13 years. And, what I've seen, back however many years ago, really before COVID, there was a lot more focus on people, trading small accounts and trading small. And what I've seen through the years is that there's more of a push towards funded money. And again, this is not I'm not going to go into I know nothing about prop firms. I'm not going to I'm just going to leave it with that. The only thing I'm going to talk about here is the psychology and what you have to be careful about. What you have to be careful about in trading is thinking in terms of your psychology and protecting it. And anything that forces you to start thinking about money or what you could make is going to damage your psychology. And you have to be very, very careful about that. And the reality is, the other thing you have to think about is you've got to do what works best for you. At the end of the day, it doesn't matter what others do. If the reality is, some people, I'm sure prop firms work great for them. For other people, I think prop firms are an absolute terrible idea. But the point is, what strategies suit prop firms in your trading? What strategy suits prop firms in your opinion? I think a strategy where you can consistently make some number a day suits anything. And thinking about money, thinking about whatever it is, I think it's just really, really dangerous. Focus on a process and the outcome will take care of itself. And I think it's, when you start having goals as far as financial goals, you got to be that gets really, really dangerous. That gets really dangerous. Okay, question. Considering that scaling into trades significantly reduces the overall R, that's not exactly true. Okay, question. Considering scaling into trades significantly reduces the overall R, what scaling limits would you recommend? For example, scaling in 3 times into a 1R trade and scaling in once to a 5R trade results in a similar R. Well, there's kind of a fundamental issue with your trade, with what you're saying. So scaling in, you can argue, does scaling in reduce the overall R? Kind of. Scaling in technically, sort of. It really depends on how you're scaling in. So for example, if this is not really a great day for it, but if I sell the close at 42 and I sell more above 43 and I hold for a second leg, my overall R is actually going to be better than if I sold 2 contracts at 42, held for a second leg. My overall R would be less than if I sold 1 contract at 42 and 1 above the 43 high and held for the second leg. I think one of the problems with traders scaling in is that they naturally scale in to inopportune locations. They scale into something like this and they get trapped. And so the point is, as far as, and then this person said, no, I mean reward compared to risk after scaling. No, I get what you mean, and that's what I'm saying. What I'm saying is scaling in actually can improve the overall risk reward on the trade. And one of the challenges that traders have in general with trading ranges is they enter at locations that are not ideal. So for example, if a trader buys the close of 6 and they scale in on 7 and 8 and they're willing to hold for a larger portion, it's going to improve the risk reward versus a trader simply just buying the close of 6. So the question that you're asking is ultimately, how many times should I scale in? And the tricky part with scaling in is that's not really the right thing. That's not the right way to think about it. What you have to think about is when is the premise no longer valid? I made the comment down here. I talked about traders buying the close of 54 and buying more lower on 57. And I said they're kind of in a tight situation. They're in a difficult situation right here. Because if the market falls below 47, it might race to the downside quickly. But it also may just go sideways in reverse. And so one of the fundamental issues that traders have with scaling in, they buy 54, they might buy more somewhere down here, and then they get stopped out below 47, and they don't have the ability to re-enter. The reality is there's 2 forms of management to that overall scenario. Scenario 1, if you buy 54, you buy 1 contract 54, you buy 2 contracts 53, and the best thing to do would be to double your position during 63, because this is a critical area. If this bar gets followed through, it's probably going to fail. And that's why a lot of traders would double their position here. The other option is to get stopped out down here And then if the market starts to stall and go sideways, you reestablish your position. So you buy, scale in during this bar, or maybe you don't, and you get stopped out here. And then when the market closes, 63 closes a tail, you start buying your position again, and you reestablish that same position, and then you hold. That's one option. But all of that requires, what it requires is experience. So really, ultimately, what you're asking, ultimately your question is basically, you're asking how do you trade with a bad risk reward? That's kind of the sense of the question. And one of the challenge, whenever your risk reward is bad, a 1-to-1 risk reward is really not great. It's technically a bad risk reward, and less than 1-to-1 is worse. And so the challenge traders have whenever they have a bad risk reward, which is a risk reward of 1 or 1R, it's the same meaning. Whenever the risk reward is 1 or less, they have to be able to actively manage the trade. And what that means, and that's where the advantage comes. That's why you see traders, if you were in Orlando, you saw Al several times, and even Ali, they took trades where they didn't have a stop in the market. They had a mental stop. And the reality is they were planning on exiting the trade long before the stop got hit. And they use stops when they're actual trading, they use stops. But the point is, a trader's not going to let that stop get hit. And that's the challenge. Buying up here, 54, the stop is not the 47 low. The stop is somewhere, a stop is a successful breakout below the 47 low. And so that becomes difficult because a lot of traders, if they buy up here and the market reverses down, they'll take the loss and then re-enter on the second leg. So I hope that makes sense. How do you find the confidence to decide today was a trade? How do you find the confidence? Okay, question. How do you find the confidence to decide today was a trading range day? Use a wide stop on a day like today, where there's a good mix of limit order and stop orders. That's the fundamental challenge that traders face with discretionary trading. The reality is you find the confidence based on experience. I find that's just the easiest explanation I can really give is I've been in these situations. I've been in a situation where I held short on the close of 63 and then I got stopped out at the end of the day. I've been in situations where I bought up here and I got stopped out below 47 and I was too upset to take another trade. I've been in situations where I bought and sold aggressively on the open and got stopped out. And I learned through my experience, through time, I learned that the reality is most opens are going to go sideways. When I see a rally 4, 5, and 6, I've just become more accustomed to believing that whatever rally I get on the open is probably going to be disappointing. It's easier through time to understand the daily chart. And that's trader's imagination. When you start out, you're stuck thinking about this chart, and that's all you can process. You can just process this and this. And it's hard to think about all the other bars. And that's why traders always ask, how many bars should I use? How many bars should I see to the left? Do I look at 10? Do I look at 20? And they get confused because they'll see some traders, they can see all these bars to the left. But the reality is, traders, they'll ignore when a trader's looking at all of this. You see me have this window. Al, I basically just duplicated the window from Al, and just through the years, I've gotten used to looking at it. I don't explicitly trade. When I'm trading, I care about some of the higher time frame stuff just because I'm aware of it, but I really care about the bars themselves. That's 99% of my decisions. But the reality is you start to understand it. Most days are going to have trading range price action. So I know that's not the answer that you're really looking for, but that's just kind of reality. When do you decide to use stop orders and limit orders, and when do you know to use both? Depends on what the range is doing. For me, what I like to look for on the open is I like to try and catch the opening breakout, or I like to try and fade the opening breakout when it appears to fail. So here, opening breakout 4 and 5, it pulled back, it got a second leg, it got another second leg, and I thought this was forming a wedge, and therefore that wedge may evolve into a trading range. It went sideways and reversed down. So that's my overall thought with trading the open. And then as far as stop orders and limit orders, it really just depends on what type of open. I wish I could explain all that, but that would take quite a bit of time. Okay, why was it probable price that we would test the low of 1? Because of the higher time frames. I thought that on the 15-minute chart, I thought this was climactic. This is a large bull bar late in a rally. That the odds were high we'd fall below it. I mentioned on the daily chart, I thought we'd try and close this gap right here, which we have yet to close it, but I thought we would. So when I saw a spike in channel, I thought the odds were pretty good that we may try and fall below 3. My other thought was that whenever you have an 18 bar range, 90% of the time, the range, 90% of the time you've seen the high or the low of the day in the first 18 bars. And if you look at bar 19, the market actually, I say that, the market went one tick above the 18 bar range on 19 and reversed down. And because of that, the general probabilities whenever you get a breakout of the 18 bar range, the general probability is in the first 18 bars, if you get a breakout above or the high or the low of the range, you've seen the low or the high of the day. So theoretically, we broke above 18, the 18 bar range on 19. This should be the low of the day, but it was only a one tick breakout, so it's kind of meaningless. Plus, we're in an overall trading range, and we have higher time frame context that supports the market pulling back, and that's why I thought we'd probably get the sell-off. It's kind of like tomorrow, if we form this open and we rally on the open, guess what I'm going to assume? I'm going to assume we're going to fall below the low of the day. So we have a micro channel from here to here on the daily chart. That makes me think we're going to fall below yesterday's low sometime tomorrow, assuming we don't gap down. Okay, question. Was the exit on your sell of 27 here, was your exit the 44 or the 47 high? Oh, so where did I get out? I can't remember exactly. I think I sold 27, and I think I got out on the close of, I got out at the close of 46 during 48 after 49 was disappointing. I believe that's what I did. And I sold below 60 over here. So I think if I remember correctly, I'd have to check. I think I sold here, scaled in, got out at the close of 46 during 48 after this disappointment. I bought the close here, scalped out, and then I believe I sold 60, scalped out during this bar, and then I think I bought the close of 65 or a pullback, and then I got out somewhere in here. That's the only thing I did today. All right, question. Thank you for everything that you do. According to Ali, bar 28 and 29 are reversal and follow through. So bar 28 and so according to Ali, this is a reversal and follow through. But can bars 45 and 46 here also be a reversal and follow through if small enough not to be breakout bars, even though it didn't create a pivot point? Yeah, okay. So I'm assuming, basically, to give you the answer, and again, I'd have to, you're probably referencing a paint bar that Ali, a lot of you have from Orlando. There's a breakout paint bar that's red and blue that Ali created for a lot of people in Orlando. And basically, I think his definition of a breakout, his definition of reversal, if memory serves me right, the reason why, what bar did you mention was a reversal? 28 and 29. Where is 28 and 29? Oh, here. The reason why 28 and 29 is a reversal and follow through is because it's reversing the direction. So I believe the code has to do with bar direction. 27 is a bear bar because it closed below the midpoint, and therefore the reversal, it's a reversal and follow through. For example, this is a bear breakout, and that's because it's not reversing the direction. This technically is still part of a breakout because it's not reversing the direction. But I believe this bar, 49 and 50, would be a reversal and follow through because the prior direction was bearish. And that's kind of the logic of breakout and follow through versus reversal and follow through. Breakout, so this is actually a reversal and follow through. because it's reversing the prior direction. This is a reversal and follow through because it's reversing the prior direction, and so on and so on. I don't give the, I think about that, but I really think more about them as just breakouts. And I just think about breakouts as being strong enough for a second leg, but you can certainly classify them differently. Okay, so it looks like that's it for questions. So as far as tomorrow, I think there's a chance. I think we're probably going to try and sell off, and we may just gap down on the open. That would be, and therefore, I think we will fall below today's low, but we'll see. Okay, thanks everyone for hanging out, and I hope everyone has a great rest of their day.